All right, and we're live. Good afternoon, everybody. It's the 13th of May 2026. The time is just after 4 p.m. UTC. Just give me a quick confirmation that you can see my screen and you can hear my voice, please. Thank you, everybody, for joining. It's been a while since I last streamed. Plenty to talk about in today's stream. Should be a good one. I've got a special guest joining us today, Trader Magus, somebody who I've got a lot of respect for as a trader and as an individual and a friend. All right, excellent. So as always, a special thank you to PrimeXBT for partnering with me during these streams. Anything said in today's video is not financial advice. And without further ado, we've got some pretty interesting topics to talk about. We'll probably cover Bitcoin to begin with, but really what I wanted to do was segue into Magus's journey as a trader, particularly around his experience over the years and how his style has amalgamated in terms of how he uses order flow and how he trades and some of the styles that he trades and the workflows that he uses. And it's something that I've been really trying to streamline myself. So I think it's going to be a very good stream in today's session. So without further ado, I'm just going to introduce Magus. Magus, are you with us?
Hey, brother. Thanks for having me.
Yeah, good to have you, dude. Hey, Magus, sorry, just repeat that again. I just want to make sure that the audio is coming through. And audience, whilst you're listening, if you just confirm that you can hear Magus okay. How's your day been, man?
Good. Not bad. It's been a kind of a slow day for me. I haven't taken any trades yet, so
Yeah.
just relaxing a little bit.
Yeah, interesting point in the market. I can see that we're trading at the 78k level. I saw a tweet from you, I think it was earlier or towards the end of last week, where you were contemplating that we could be going through a short-term topping pattern, or if that wasn't to hold, then we could potentially see significantly higher. So very keen to grasp your thoughts around that.
Yeah, essentially, I've been long biased since 65K, and originally my plan was, the first half of Q2 would probably be bullish, and that's kind of played out more or less. And as we push into the 82 and 84K region, I expect bulls to probably fail there. If bulls get over 84 in like a convincing way, not just like some sort of wick, but an actual, break above and hold, then it could trade a lot higher into the direction of 100K, but my core plans are built around us failing at 84K and having more of a kind of bloody range environment for a couple of months before we get to Q4, and then I think that maybe we have a good chance of having an uptrend once we get to Q4. You might be muted. So I entered into financial markets and started on the investing side of things over 11 years ago. I started actually trading about 8 years ago, and I went full time a little bit over 6 years ago now. So it's been quite a long time now. I'm definitely old in trading years. Yeah, really quick, like we could do kind of a higher time frame overview. My plan was I've got a couple of doodles I could share, I guess. This is the quarterly one, if it'll load. Going into Q2, I thought Q2 would be bullish. I thought we would have some sort of pattern like this. It's kind of playing out pretty well where I figured we would move into the direction of 84K and see momentum loss and see some kind of signs of weakness. I don't think it'll just trade down in one candle. There's probably a decent chance that we get a bounce here soon and try to test the upper regions again. And then from there, I think we'll probably see a bit more of a pullback. Can come over to this screen really quickly. This is my macro plan, right? The idea that we would likely struggle in the region that we're in. If we get above it, then we could see price trading a lot higher. If I was to throw probabilities out on that, I would say this is a really low probability of us trading up. I think that we will probably pull back a little bit from here. Trying to predict levels to the downside, I'm not really super interested in. Maybe we trade down into the 70, low 70s. Maybe we trade back into the 60s. Well, I want to play it day by day on that front, but something I'm pretty confident in is that we're likely to play out similar to 2023. So I think the price will compress as we get into the later stages of Q3 and towards Q4, and then hopefully see kind of an uptrend from there. I am prepared for the idea that maybe we compress and break down from there too. You always want to have all the different scenarios, kind of planned out so that you're not caught flat-footed if you're wrong. Because at the end of the day, I'm predicting right now, and predicting isn't really, I'm not gonna have a super high, like, I'm not gonna have a 100% hit rate on predictions. They are useful in some regard because they help you be prepared for the potential scenarios, but at the end of the day, this is like, educated guesses at best. But yeah, that's my main framework right now is I think that we'll probably see price compress a lot in Q3, probably trade down a little bit before then, and then I'm hoping that we see Q4 be pretty bullish this year. Well, as far as other kind of market views, I don't have a whole lot else to share on that. My focus has been either on TradFi more or on a lot more of the lower time frame trading. So as far as big picture Bitcoin, that's more or less it, really, right? I think that there's a reasonable expectation that we try to test 84K in a more convincing way. But if we, either way, I think that in the next couple of weeks, it probably makes sense to transition more towards a defensive mindset as opposed to an offensive, bullish mindset. But all that is like kind of resolves in a bullish way, right? I have a expression I've said over the years, like bull to thrive and bear to survive. I think that you probably want to be a little bit more bearish so that you don't like round trip your gains that you've had. But all that is in the mindset that you eventually want to going back into the bullish direction to kind of benefit from the upside to follow. If you want to take a second to mess with it, that's fine. Otherwise, I could also just yap for a while if you want to let me just run with things while you fix it, either or. Well, I definitely I stream every week, so I definitely know how to yap. Okay, well, I'll go ahead and just start yapping about some stuff while you sort it on your end. Um, so originally XO asked me to talk about how I had kind of made transitions over the time. So I don't want to yap too much about like kind of the origin stages, but the way I like to word it is in 2019 when I started to get introduced to order flow, it was, very much a light bulb moment for me where things started to make sense a lot more. I've used every popular order flow tool that exists, and over time I learned to condense it down and really only use the tools that I really need. So today I'll talk about the stuff that I use and what I would consider, essential for my own trading purposes. Before I get into any of that, I want to preface and say that it's not a one size fits all thing. If you find that one of the trading tools that I don't use really resonates with you and works well for you, it clicks with you, then use it, right? It's not a don't take this as an approach, that because I said something's good or something's bad for myself that you should just follow, right? You should try to tailor these things to fit your own personality and what clicks for you as an individual. Um, so yeah, I can go ahead and talk about a couple of things.
Yeah, sure. That sounds good to me. Yeah.
Okay, so as far as workflow goes, I'm gonna just start with something like a fairly simple concept, and then I'll start to actually like, break down more detail-oriented stuff. As far as workflow goes, for me, what an average day looks like for me is I wake up pretty early, because of my time zone. In order to trade New York session, I have to wake up pretty early. Every day before I actually trade, about an hour before the New York session comes, I normally put together my trade plans. When I'm putting together trade plans, that is, um, scanning, VWAPs and volume profile, looking at what the taker flows and the liquidity looks like. And if any of this stuff is unfamiliar to you, I'm going to explain all this later. I look at what the previous sessions have looked like. Just because yesterday was bullish doesn't mean today is going to be bullish, but there's generally like a bit of a kind of, I don't know if I want to call it a trend, but what has happened over the past several days gives me some context as to what's likely to happen today. That could be because we're bullish 2 days in a row, so maybe I'm bullish today, or maybe it's because today is less bullish than yesterday. So that makes me think that, like it's more of a range bound environment, or maybe we're set to do like some sort of pullback. So I use previous sessions to contextualize things a lot. And then all this like ultimately is to recognize what kind of environment we're in, whether we're trending, whether we're ranging, whether bulls are in control, whether bears are in control. Because something that a lot of traders really mess up with in the early days is always thinking that it's a trending market, or always think it's a range bound market when you are constantly transitioning between the two. So it's really important that you get that part correct because otherwise you're just gonna be wrong on most of your trades, right?
Yeah, I mean, one of the questions that I think from what you've just said, and maybe a good way to frame this is context is king. And I think where many traders get caught up is indecision as to whether they're swing trading or whether they're going to be looking for intraday or intra-week rotations. Now, what determines whether you are looking, because I know you're very similar to me, you look for swing trades and you look for those, good rotations that you can take, maybe one or two setups a day if they come to the surface. But what helps you pick out whether you're actually going to be swing trading or whether the focus is away from swing trading and you're just going to be looking for those intraday or intra-week rotations?
Yeah, that's a good question. Sometimes I forget to, go over some of the like more introductory details. I just kind of, I think about what I think about and not always what everyone else is thinking about. So that's a great question. Um, two things I would say. So environment recognition is going to be one of the most important things. It's going to tell me whether I should be swing trading or not. If we're in some sort of really strong uptrend or downtrend, then I'm going to lean more towards higher time frame trading a lot of the times, especially when we're in an uptrend. If we're in an uptrend, there's really no reason for me to allocate a lot of my time and energy towards day trading because I could, realistically do a lot better by just focusing on the swing trades and the portfolio management. The next kind of thing that I would say is that I'm kind of always swing trading or doing portfolio management, and it doesn't really matter what time of day it is for that. But for day trading, it's like something I was going to explain here in a minute was the session based kind of idea where it's almost like a day job where I know that you know the New York Open comes and that's like the time to clock in for me, and then I normally work on the day trading front for anywhere from an hour to two to maybe if it's a bad session maybe like 6 hours past the open on that's kind of like on a day that doesn't really go that well for me. But I mean you should always sit down and know what you're doing, right, guys? If you're sitting down and you're clicking buttons and you don't know if you're swing trading or if you're day trading, you're probably doing it wrong, right? For day trading, you need to be very aggressive with your entries, very aggressive with your exits. And when you're right, you recognize that quickly and you profit from it. When you're wrong, you recognize that quickly and you close it out quickly, right? But with swing trades or with portfolio management, you have to have the kind of the opposite mindset where you're not as execution focused and you're much more, maybe fundamentally based, or you're just like on that much, more patient time horizon. So, to
Yeah.
TLDR that and make that simple, it's, recognition, whether we're in some sort of strong trend or not, and kind of identifying, what time of day it is for me, right? Because I basically day trade the New York session from Monday through Thursday every week, and when I sit down and make my trade plans to trade New York, I'm not gonna have any mix up where it's like, oh, I should take a swing trade right now. Maybe I'm gonna maybe be a little bit of a hypocrite right now and say that sometimes I do. So every now and then, maybe 1 out of 100 days, I'll have it where, okay, there's a higher time frame trade that is lining up with my day trade, and I'll take them around the same time. But that's ultra rare, and I would really advise most of you guys to not do that and to like really highlight one or the other, because it's really easy to kind of step on your foot, right,
Yeah,
and
yeah.
mess up when you mix them.
Yeah, I'll probably interject and say one of the issues that I had in the early phases of my career is when I'm looking for a swing trade sell in Bitcoin, and I'm also looking for an intraday rotation, my bias would be contaminated across both trades where I fuck up the swing trade and I've also screwed up the intraday rotation as well, because it's you start fidgeting around with the swing trade, and the way around that, or what I found what actually worked was for my intraday rotations, trade a different market. And for swing trading, trade a completely separate market until I'm competent enough to actually feel comfortable that I can run 2, 3 accounts trading the same asset like Bitcoin. So what I've been doing over the last 2 weeks is I've been looking to build a short position since we've traded 82.9. I've had an attempt at swing shorting it earlier prior to that in the 81s, which I cut the trade, and then I'm looking to re-enter the trade, which I've managed to do, and I've held that position. I've been building that position. But I think what I've noticed, especially with some of the members in the Paragon, which I think you've done a fantastic job of, educating and teaching some of these aspiring traders there, is the environment that we're currently in, with Bitcoin having been trading around this 80, 79, 80, 81, 82K level. There's been some fantastic rotations, but I just want to take it a step back because, we've both talked about context. Everybody talks about context. And I think what would be really good as a next segue is, why don't you show us what you actually use, or kind of give us a high-level overview that when you come to the desk, all right, are we in a trend environment, and what tools are you using to recognize, okay, yeah, we're in a trend day today, or what are you looking at to decide whether, okay, today we're going to be range bound or we're going to be rotational? I know different traders have different approaches. Some like to use ATR, some others may like to use the weekly VWAP band and look for those mean reversion trades, as long as we're in a bracketed, balanced environment. But let's hear it from you in terms of how you actually gauge context when you come to the desk.
Yeah, so this is an easy one for me. The answer is just two tools, VWAP and volume profile. A lot of the times they're going to give me the same information, but maybe every now and then there's a subtle difference between the two. So right now I'm looking at a monthly chart. This is a monthly volume profile and a monthly VWAP setup. I could show you guys this on the day trade setup too. It's the same exact kind of information more or less, just on a lower time frame version. So using daily and weekly. But essentially all I'm doing is I'm looking for, how is the volume distribution on the profile shaped? Is it balanced or is it imbalanced? Which, essentially I could draw this to make this easier for you guys. If it's balanced, it's going to be essentially a perfect bell shape, right? That's what a balanced distribution would look like, where an imbalanced one is going to have kind of multiple distributions within, the volume profile. So when it's balanced, it tells me that we're likely to be range bound, and when it's imbalanced, it tells me we're likely to be in more of a trending environment where we're going to get more volatile, kind of up and down moves. Um, what I can show you guys that's even more simple than that is how I do the VWAP stuff, right? So The simple argument that I always make is when a VWAP is flat like this, it tells you that you are in a reversion mindset. And when it's sloped upwards or downwards, I don't know why my mouse keeps messing up my lines, but whenever it's sloped upwards or downwards, it tells you that you're in a trend. So this is a lagging indicator in the sense that, you're already going to be trending or range bound by the time that it's telling you to lean in that direction. But it is a really simple way for you to look at a chart and say, look at the chart that we're looking at right now, guys, right? So my thesis has been to be bullish throughout the start of Q2. And if you look at this chart on the monthly, ever since the start of Q2, we've clearly been in an uptrend, right? Everything is sloped upwards. We're continuously, last month we were continuously using the value area high for the month as support, and everything is, sloped upwards. And we look at the current, developing from the start of May, and it's a lot more flat, right? So this is a much more balanced flat kind of distribution, where last month was a very strong uptrend essentially. So that is really all I need to get context, to know whether I want to bet on up or down, whether I want to bet on reversion or momentum. That's really all I need. This works on, it's beautiful because you can look at a chart. It could take 5 seconds for you to tell yourself what you're supposed to be doing, and it works on every market that exists. So that's pretty much all I use.
Yeah, question for you. So when you look at something like this, where the context is clearly it's been drifting higher, are you still trading both sides of the markets where you're looking to sell the extreme moves, or is your focus generally where, because the market is trending up or the value is shifting higher, you're just basically looking to keep long in the pullbacks using some sort of mean reversion system where you're looking for continuation higher?
Yeah, good question. So how I would word it is I would break it into whether I'm trading higher time frame or lower time frame. So for higher time frame, I would only be looking to trade the long side. But for lower time frame, when you look at this chart, it looks like it's only trading up. But when you actually, if we look at it on a lower time frame chart, there's going to be plenty of times where it's going down quite a bit. So the simple answer is for higher time frame, I'm only going to go with the trend. For lower time frame, I'll go both ways.
Yeah, it makes a lot of sense. I think the good thing about that, there's plenty of opportunities, and I think the price characteristics that we've seen on Bitcoin for the best part of the last 6 weeks has really been a beautiful rotational environment. We've not really had any explosive breakouts. We've not really had any significant rallies. It's just been back and forth price action where the market is drifting higher. However, looking at the current price action here, I do believe that we are due a corrective phase. I think one of the key levels that I'm looking at is around about the February highs, and whether we actually start trading back into February's range between the low 60K to the high 78K. And I think if we do, then the next question for me is then, if we do get a shift in the market semantics and the current context, which has clearly been a grind up, okay, a slow drift higher, and if we are starting to, let's just say, distribute around these levels, when do you start looking for potential swing shorts, or is that something that you're positioned into? Because I'm personally swing short. I'm preempting the fact that I think we're going to get a correction heading into the summer months. I don't know what type of correction that's going to be. That's partially not really something that I'm trying to predict. I just recognize that, okay, we're at an inflection point. I think we could get a correction. That's something that I want to take advantage of. I'm not trying to call being bearish or bullish. I think if we break back into balance, then that's a market that I want to flow. Just like we've been flowing to the upside, then I want to start flowing to the downside. And within there, my swing trade will be running to the downside, but within there will be opportunities to sell extreme intraday or intra-week oversold conditions that you can play back into the mean reversion. So my question to you is, how do you actually do that yourself? When do you recognize these key inflection points on the higher time frames, and is that something that you generally position for, where you start going from attacking the market from a long perspective, then you transition into a period of defense, like I saw you tweet from last week, where you started marking out this could be potentially a local top, we could see a corrective move? How do you actually trade for that? How do you position for that yourself? And again, does that constitute of you've got a swing trade running, or you've got a hedge running, and then you're looking to keep continuing with the intraday, intra-week rotations?
Yeah, good question. So, a couple different things I could say about this. One simple response is that I don't really swing short to the downside. I am mostly hedged to the downside, and I swing long to the upside. Um, Throughout my career, I've really not had very many years where I made, any sort of decent gains from swing shorting. 2022 is the only year ever since I have, entered the markets where swing shorting worked really well for me. So a simple part of that equation is that I really just go 1-to-1 against my Bitcoin stack on the short side to hedge it. And basically trying to defend yourself from the drawdown and then being long when Bitcoin goes up has been a really good strategy for me over the years. The next part of that conversation is around how do I kind of attack the inflection points. So sometimes I'm aggressive, like you just described, where you're kind of preempting it and trying to get in early. An example of this would be when I went long on the 65K wick over here. I closed out my hedge and went spot long at this point and rode the whole trend up. So sometimes I'm aggressive about it where I kind of preempt it and more or less take the risk where there's a reasonable chance I could be wrong and then I'll have to, reevaluate things. Um, so looking at the example that we have in front of us, how would I play this? Well, I'm not going to just open a hedge into the candle that we just printed most likely. The couple scenarios that I could see playing out would be one, us kind of bouncing from the region that we're at. Maybe it trades a little bit lower or maybe it bounces up from here. And like I originally said, kind of looking at that 84 or maybe 83K area, if we get another like move up into here, especially if it feels inefficient and I identify some problems with it, then I would maybe go for the more preemptive style where I would try to hedge up here and hopefully ride it down. The alternative path is that if I don't get this kind of move, I'm going to be looking for like, clear weakness. So on this chart, what that would look like would us be kind of losing this kind of region and breaking down below here. And then I would look for a kind of a going with momentum kind of hedge. My mouse is like breaking for some reason, so it keeps drawing the lines wrong. But those are the two kind of scenarios, right? Either the preemptive style where it gives us another dramatic pop up and I look to hedge higher, or we see, sustained weakness for a couple of weeks. And then, I basically see some sort of short-term up move, and then I sell into that for, expected continuation. So I think if we were to see sustained weakness, it's May 13th right now. So if we were to see sustained weakness throughout the rest of May, it would probably look something like what I just drew, where it would trade lower and then maybe build out some sort of range. When it builds out that range, that's what I'll use as my framework for where to hedge. So that's basically it, right? In an ideal world for me, since I'm not positioned defensively, we would get that next move upwards from where I would choose to play defense. But the market doesn't care about what you want, so maybe it just trades down from here, and then I'll have to adjust, and maybe my hedge is a lot lower, maybe in like the 76K region. But yeah, I mean that's basically the framework, right? Either I get to hedge higher or I have to hedge lower, and I have to wait and see what the market's going to tell me from here.
Yeah, it makes total sense. No, thank you for that. I think just for the audience, there are other ways that you can measure volatility as well, using something like an ATR indicator as well. So you can get a feel for the markets, whether that's on a daily basis, if you're looking to trade it intraday or scalp, or a weekly basis. So there are different ways that you can measure volatility, and you obviously want to take into account the average rotation per leg. Okay, so that's just another way to do it. It's not something that I have really integrated into my own trading, but there are parts of ATR that I've probably never discussed before that I use when it comes to trading trends. So say, for example, when it comes to using a 12 or a 25 EMA, one of the questions I often get asked is when you try trading a trend, how do you place your stop without getting too tight? And one of the answers to that question is, well, when I am trend trading and just riding the moving averages, whether it's to the upside or to the downside, that's when I'll incorporate a dynamic moving ATR bands along, which kind of is my invalidation or hard stop, that if we start pushing above there, then I'll have to close out the position. All right, great stuff. So thanks for covering context. I don't know if we've got any questions so far, but I think one of the things that I've learned from you as well, actually, and many others, is that when it comes to the summer months, you generally, correct me if I'm wrong, but take a step back from the markets and you come back with rejuvenated energy, I guess, for Q3 and Q4. Is that something that you're going to be looking to do over the summer months with Bitcoin's price action? I think when we look back at 2025 and 2024, the summer months have generally been quite slow, haven't they? Very rotational, very range-bound-like environment. And that's something that I do, that when it comes to the summer months, I take time out, and I'm only interested in doing business when prices are at the extremes of some high time frame VWAP or at the extremes of some higher time frame ranges that I've identified. So I generally try to avoid a lot of the chop that occurs during the summer months. But very keen to know what your thoughts on what you're looking to do this year.
Yeah, so I don't, have the stats in front of me or anything, but ever since I started trading, I think there's maybe only been one summertime that was actually active, and I could even be wrong about that there, because sometimes it's easy to, where I live, to blend the different, Q2 and Q3, because technically Q3 is the summertime, not Q2, from an actual seasonal standpoint. So, um, yeah, basically there's just a pattern that you follow every year, more or less, where you're like a lot less likely to have the volatility and the trade activity taking place in the summertime. The low IQ way that I used to always describe it was that the big boys want to go on vacation and spend their time with their families and stuff, and they don't want to run the markets. Um, for me, how I view it on my own end is that, if you are always at your screen, always trading, it's very easy to burn yourself out. I've had a lot of issues over the years with burnout and loss of motivation, and I always have to find a new way to keep myself going. So over time, I did start to recognize the idea that you need to kind of pre-plan, um, some time away from screens, right? So this summer, I have 4 trips planned, or I have 3 solidified planned, trips planned, and then hopefully I'm going to be doing a fourth one where I go out to Florida and hang out with Doc. But yeah, I mean, it's good for you guys to take time away from screens. It's very, when you're starting out, it's very difficult to take the time off because you feel that pressure of what happens when something great happens while I'm gone. And worst case scenario, something great happens in the market and you miss it, but there's always the next opportunity right around the corner. And if you work yourself to death, you're going to, not kind of have that energy, that motivation to sustain, to keep pushing forward. So I actually, when you've only been trading for a couple of years, maybe it's fine. I don't want to be a hypocrite because I didn't really take time off early on either. So I get that, that extra, kind of need to work and need to trade. But as time goes on, especially if you start to kind of hit some sort of level of success and things work for you, take time off to not only for yourself, but for your friends and family too, right? I mean, because this is a selfish game, right? Like most traders have like kind of our level, have a level of selfishness, where you're kind of thinking about yourself all the time. It's really good to, go and visit your family members, make a trip with your friends, so that you don't lose these people in your life. Because at the end of the day, if you're doing all this stuff and you don't have anybody in your life, what are you doing it for at the end of the day, right? If that makes sense. So TLDR is, I kind of plan around the summertime as normally being the convenient time for me to take time off. It normally works out really well when markets are slower during that period, and it gives me an opportunity to recharge myself and also, see my family and see my friends and, stay a human basically.
Yeah, makes sense. I think it's important that look, from my own experience, when I first started trading, there's a desire to be at the desk every single day because you feel you're going to miss moves. And I think really where the issue or where the psychological issue comes, or maybe, in the past for me, I think the crypto landscape is different today than what it was in 2018 through to 2022. I think back then it was very easy to get caught up in the mindset of looking for opportunities because you were so accustomed to, altcoins moving 5 to 10x. Whereas I think in the environment that we're in today, if anybody who's joined the market, well, you probably haven't experienced, catching those 4 or 5x moves within a matter of weeks. I don't really think we're in that environment. I'm not sure whether we're going to see that anytime soon. So I guess for those of you who've been around for the last 7, 8 years have probably seen that. You've experienced that, the ups and downs, and it's very easy to get caught up between wanting to be at the desk and looking for opportunities. But then the question is, are you actually playing cyclical plays, or are you actually trading, like actively trading perps or futures? But now when I look at the market, I'm very rarely trading altcoins now. It's more heavily focused upon Bitcoin, Ethereum, Solana, Hype, and a couple of the major caps. And what I generally tend to do is I don't have a desire to be at the desk every single day. Sometimes it really depends upon the volatility. So if you take, for example, October, when the market was topping out at 125, that was something that I sold, and that's something that I was publicly not vocal about, but I raised my concerns that I think we could get a rejection from this level. And from that, you have to anticipate, just like Bitcoin right now, that if we're stalling at 81, 82, 83, then what's the next big rotation likely to be? Well, I think it's going to be to the downside. And if that's the case, then this is the time that I want to pay attention to capitalizing on any intermediate trends where we oscillate from 83, 84, 85, wherever it is, wherever the high is, down to low 70s. And prior to this, from February, March, April, I wasn't very active at all from a trading perspective. So I often wait for when I believe that the market is at a key inflection point, and then I get very, very active in terms of not only just swing trading, but intraday rotations. I think it would be awesome at this stage if you want to talk us through. Let's just talk about your setup, your workflow. I think that's something that I would like to see other traders talk about. And I know that you're very similar to me in the sense where you're very systematic. You've got a really well-oiled, refined way of trading and a really good system. Do you want to talk through some of the tooling and the software and the setups that you actually have? And just give us a high-level overview of your workflow and how it fits into your trading moving forward.
Yeah, no problem. So I've already covered kind of the simplistic argument around profile and VWAPs, so we can maybe skip over that. This is the template that I'm using for my day trading. So we were just run through it piece by piece. This first panel over here is where I, this has essentially become a replacement for my TPO chart. I do have the TPO over here, which we can discuss just for the sake of education, but this has essentially been the replacement for my TPO. It simplifies things down. This is where I identify my composites, and we have an indicator that automatically marks out all the anomalies. So it will, show us the single prints. It'll show us the MPOCs, the poor highs, poor lows. It'll just automatically draw those things for me. And this is a lovely tool. So this is not something that I would use for execution per se, but more so for trade planning. So this will help me identify where I want to trade more than anything. From there, we can, this is a really simple one as well, but this is just where I do my anchored VWAPs. So I'll pick a key point for anchored VWAPs.
What does sorry to interject. What defines your key point? How do you actually pick a key point? Because I see a lot of, I mean, I don't want to say traders making mistakes with where they choose their anchors for like fixed range volume profiles and anchored VWAPs. But what's kind of your rules around picking an anchored VWAP before you continue to talk about the anchored VWAP? It's always an interesting question that I like to ask traders.
Yeah, so for the anchored VWAP, I have maybe three ways to apply it. The most simple one is going to be a swing high or a swing low, right? So this is a swing low, you could anchor it from here. This is a swing high, or this is a swing high, so you could start it from there. That will tell you, so if you draw, an anchored VWAP from here, it's going to tell you at what point, are bears in control and at what point do bulls kind of take back. So if you were to draw it from here, you would clearly see that bears have been in control for the past, week or so. So that's the more simple example. The next one that is more nuanced would be more of an event-based thing. So I would caution you guys to be a little bit careful with this, and maybe you could skip over this one, but I have used this in the past where when there's a major event in markets, let's say it's the launch of the Bitcoin ETF in 2024, for example, where some sort of like major event that takes place, I will normally anchor a VWAP from there. Then the final version of this, which is a pretty simple one, so this is maybe worth you using. It's the same exact logic for how I draw my volume profiles, or for the non-automated ones, the manually drawn volume profiles is basically once there's a strong impulse and the impulse stops, I will start the VWAP from there. So in this specific example, this is a really important impulsive move where we went from 67 to 72. This was basically the start of the trend, or this is the initiative move where once we had built out this range at the bottom, we had seen our first really strong move up, which really solidifies the fact that we're going to trend. So the reason why I draw this is it basically shows me how value is shifting upwards, and it shows me the stability of the trend, right? How we're not losing the VWAP at any point. We're actually more often than not, we're consistently using the value or the standard deviation 1 or the value area high as the kind of point to bounce from, or like a major level to interact with. So that's basically how I use the anchored VWAP. For most of you guys listening, I would say anchor swing highs and swing lows. And maybe if you want to do it like I just drew right here from, strong, impulsive moves, right? That's what I would say.
Yeah, awesome. Good stuff. So I guess the first two screens that we just looked at was more for trade context, areas of interest, right?
Yeah, 100%.
Levels that you're interested in. So that's kind of the trade context and how you kind of picture or start framing the trade before, I guess, what makes logical sense before you start thinking about trade execution.
Yeah, and that's going to be a little bit more on the medium, time frame, So when I look at both of these, it's not like these aren't swing trade, tools necessarily, but it's also not necessarily exactly what I care about today when I sit down. It's more so framing the kind of context for the, larger situation that's playing out, because I do keep in mind the fact that, even if I was to trade bearishly today, I still would have in the back of my mind the idea that we have been in an uptrend for a month and a half, and I would keep that in the back of my mind. So the anchored VWAP, when I first started it, it was a more of a lower time frame thing, but we've gotten to the point where I've had to move the time frame up quite a bit to fit it all on one screen because it's been, taking place for a little bit over a month now since I originally drew that. Where this first chart that I showed you guys is much more about just telling me the levels that I should maybe interact with, right? Maybe a value area high or maybe a NPOC or something like that to get some sort of levels, because it's really easy to get lost in the sauce and have 75 levels on your screen. I mean, you look at my charts and it's like, why don't we trade here, or why don't we buy here, or sell here, right? Because basically every price point on your screen you could identify as a level if you really wanted to. So like learning to filter it down and knowing what matters and what you should trade off of is really important. So this would be the next screen that I would use. This is where we get into the realm of execution and like actual proper trade planning. So if you look at this, going into today, New York session is like right here, or actually, excuse me, it's right here was the open, somewhere over here, right here. And going into today, I would be looking at what does the distribution on the profile look like, and then what's the slope of the VWAPs. So pretty much every VWAP was bearish going into today. So that should have given you an indication of how you should have traded. But I do get some executional insights from this screen as opposed to, regarding what's going on with volume. This is relative volume down here at the bottom. And then this is open interest down here, showing when positions are opening and closing. I've got Binance on the top and Bybit on the bottom. It's really nice nowadays that I can get all this information on TradingView. When I first started trading this stuff, in order to get this kind of information prior, to get volume bubbles and to get, RVol and open interest and things like that, you had to use more advanced order flow platforms. So it's really convenient nowadays to be able to use TradingView and get all this stuff. So this would be the kind of the starting point where I would, have some sort of idea as to how I want to execute. Maybe I get some confluence in execution on this screen, but it's not the primary executional tool. I can go ahead and move on to the primary executional tool, which is what you guys see over here.
Just a quick question: the fourth indicator up. What's that one there?
At the top?
Yeah. Sorry. There's that one, and then this one here where your cursor is now. Yeah. What's that one there?
This is just standard volume.
Right.
So the reason, it's kind of a redundancy. You don't need standard volume and RVol. I have just had that on my chart for a long time. And I cut, just personal preference more than anything. You can very easily just turn this off and you don't really need it. If I had to pick between one of the two, I would definitely pick RVol because it's a much more reliable and accurate, tool, and it gives me a little bit more information where standard volume doesn't really give you the clarity or the granular kind of data that Arval does.
Yeah, yeah. And the indicator at the top, what does that measure?
Yeah, so this is it's premium and
All
discount,
right,
so it's
okay.
showing whether
Yeah.
perps or spot are trading ahead of one another. So when it's red, it shows that perps are trading below spot. When it's blue, spot is above perps.
And
And
how do you use that in your own trading when you look at premium? Do
yeah,
you
so a
do
lot of
you,
people use this one wrong, definitely. It's very easy to use this one incorrectly. So just because spot is above perps or below perps doesn't necessarily mean anything. You have to properly contextualize it to get some sort of insight as to what it means. So a lot, more often than not, perps will trade below spot. That's kind of the standard, way that basis is derived. And this is ultimately what creates the funding rate as well. And a lot of people, I don't pay attention to funding rates because I don't find them useful anymore. I would much rather look at premium and discount because it's a much more real-time indication, and funding is lagging because it only prints every 8 hours on most exchanges. So, without going too far into the weeds and explaining it right, this will help me identify if perps are leading or if spot is leading. But in order to read that accurately, you have to have some sort of tape, which is what the agar represents over here for me. Because you could have instances where, excuse me, you could have instances where it looks like spot is trading ahead of perps, right? Because spot is slightly higher than perps, but it doesn't always mean that spot is leading. It could be a liquidity thing where perps just have a really thick ask and they're not allowing price to trade up, where maybe there's a thinner ask on the bid on the spot side of things. So you basically have to factor in what's going on with takers and what's going on the liquidity side. But this is just a very quick scan way to start that conversation with yourself of who's leading and who's lagging, who's in control, and it can give you a little bit of extra just confluence as to what kind of direction you should bet on.
yeah. And then on the right hand side, I'm assuming you've got the delta volume profile there, haven't you? On the right hand side, the red and the blue.
Yeah, so it's
Yeah.
it's regular volume profile and then delta profile. And this profile today is a very strange one because the top is very flat. So this is definitely a pretty clear poor high structuring. So normally it doesn't look like this, but yeah, the gray is the volume profile. The red and blue is showing the delta, showing the difference between buys and sells. And you can pretty much clearly see that I even have yesterday included in it a little bit. So if I only show today, it's just going to be basically all red. Maybe there's some buying at the top, but sellers this is only perp data for the record. This is not spot data, but on the perp side of things, perps have just been completely dominated by sellers today.
Yeah. And is this generally your setup for when it comes to trade execution on rotations, or does this also feed into, do you use the same execution model for your swing trades as well? Because I know with swing trading you kind of have more room for variance, but when it comes to intraday you have to be very, very clinical in your execution. Any hesitation that you have will skew the risk profile of the trade, whereas in a swing trade, I guess you have that level of buffer where you can start chipping away at a level. You don't have to be precise as you would with a scalp or an intraday trade, but very curious to know, is the execution model for you essentially the same, or do you have a slightly different approach when it comes to swing trading execution as opposed to your rotational based trades?
It is the same with looser parameters on swing trades. But just for educational purposes, I trade momentum and reversion on this same chart because there is such a thing as kind of intraday momentum that I trade, where when we have a strong slope upwards or downwards, I'm going to lean into going with momentum as opposed to going against it. So when it comes to momentum and reversion for day trading, I only use this kind of template. For swing trading, it would be the same kind of framework, but with just less information. I don't trade as much flow with higher time frame stuff. Higher time frame stuff is going to be much more about, momentum and structure, and then some liquidity dynamics. But I don't, sit here and read, the 10-second agar, for example, when I want to take a swing trade. It's a lot less granular. Like you said, for day trading, it requires a level of precision because if you are early or you are late to a day trade, can completely ruin a correct thesis. You could have the right idea that we're going to go up and then we're going to go down, but if you're early or you're late to that, all of a sudden it is just not a good trade anymore. Whereas with higher time frames, I have much looser parameters where I'm not trying to be as precise because, variance on higher time frame trades is just infinitely higher, right? So you have to have a much looser parameter for swing trades, definitely.
Yeah, agreed. Agreed. Awesome. Okay, shall we move on to the next workflow setups that you have?
Yeah, I mean, I can talk about the TPO a little bit, but
Yeah.
it's not something I really use that much.
Well, and why
But
is that? Is it because you've moved all the levels now across your chart, so you kind of have visibility upon? So the top left corner of your screen is where you said you kind of have everything marked out from a
yeah,
market profile
exactly.
perspective. So I guess this is just more for reference perspectives.
Yeah, I mean, I will go through state fate. I mean, one thing you can tell that I don't use it a lot is the tick sizing is not very good on this. The tick sizing should be much smaller. If I was using this accurate, like, every day, I would have much like smaller blocks. But that's kind of the way things go as price moves around a lot. So, um, I think that this is a great like learning tool. And once you get a grasp of it, you don't really need it. Now, like I said at the very, very beginning of this stream, just because I say I don't want to use something doesn't mean you guys shouldn't consider using it. Everyone listening should try to lean into whatever makes the most sense for them. So if you really like the idea of using a TPO, then use it and ignore me when I say I don't need it anymore. But for me, everything with my trading is always about moving in the direction of simplicity as opposed to complexity. And, less tools is normally better for me than more tools. But yeah, I mean the TPO is a great like learning standpoint because it shows you, you can clearly see how the distributions are shaped. You can very clearly see the anomalies like this obvious poor high, or some sort of NPOC, which I don't really, yeah, we have the NPOC from today, but there's nothing else really sticking out. I got some singles below. But yeah, I mean it's kind of a redundancy. So more often than not, I have my charts, set up like this. I turned it on for the stream today for you guys because, I want to make this educational and show you guys all the different stuff that you could theoretically use. But yeah, I think it's a redundancy for me these days. And
Yeah.
less is always more.
Yeah, I guess it's the same with footprints. I don't really see you talking much about footprints anymore. I'm a big advocate of footprints. I enjoy looking at the granular level detail, but at the end of the day, I'm sure we both come to the same metrics and conclusion when we see high delta, right? There's so many different ways that you can view delta on the chart, whether it's through an indicator, whether it's looking at the footprints, whether it's looking at volume. So yeah, I think you, correct me if I'm wrong, but you used to use footprints, but I guess I don't recall you having talked about them in quite some time. Any reason for why that is? Is it just because you're looking to simplify the amount of information that you consume?
Yeah, so I used to use footprints a lot for my Bitcoin kind of day trading. And then from there, I used footprints a lot for scalping altcoins. But basically, ever since 2023, it's been something I've kind of scrapped from my, my repertoire. And I found it to be unnecessary because I, the way I read footprints was never really caring about the specific numbers. It was always just, kind of as stupid as this sounds to the viewers, like, if it's a whole lot of red, that means a whole lot of selling. If it's a whole lot of blue, it means a whole lot of buying. I never really read the numbers and said, okay, it's $82 million of buying here. It doesn't really matter to me. It's just more so about identifying where the, huge chunks of buying or huge chunks of selling are taking place and then getting context from that. I actually went back to my roots eventually and kind of stepped away from footprints and started using the agar stuff more. So basically, what agar is a footprint in the way it's depicted right now. It's just in a much less specific kind of way, right? So how I get around that is I use ultra low time frame or use tick charts instead. If I was to use this on like a 15-minute chart, it wouldn't give me enough information. But because this is on 10-second right now, it gives me that same kind of read that a footprint would in just a way that is a little bit more simple in my eyes, at least. For some people, this will be more complicated. So take everything I say with a grain of salt here. But yeah, this has essentially been my replacement for footprints. I read the tape through this. I don't really like traditional tape reading where you're actually looking at the buy and sell orders going through in a standard, time and sales kind of method, as opposed to trying to read that. This, is a permanent record where it shows me where the spikes in buying and selling are taking place. And I found over time that this is just a much, better approach for myself. And this is what I lean into with my education. And I always, I was having a conversation with a student last night actually that he really likes footprints, and he was feeling maybe that he shouldn't use footprints because I don't like them, and I really like kind of strongly said like, look, if it's working for you, if it makes sense for you, it's all that really matters. So yeah, that's the
Yeah.
TLDR on footprints.
No, yeah, that's so true because I'm a big advocate of footprints because I think what people don't understand is that there's so many different ways that you can read the market in real time. Now, just because, yourself, let's say you probably don't like using footprints at this current phase in your career. I'm somebody who's on the opposite side. I absolutely love footprints. There's no right or wrong answer. I think what it really comes down to is, okay, so here's a footprint tool. What system can I, from the information that is available to me, how can I create this into a strategy that makes sense to me that I can trade? Okay, that's where it really comes down to. There's no point in having all this information on your screen, whether it's footprints, market profile, or price action charts or moving averages. If you cannot develop a system as to understanding why you're using it, what is the reason you're looking to use it for, and what are you trying to gain by using that tool, and how does that assist you in your decision-making process, and is that decision-making process executable over the next 100 trades? And not only is it executable, but then how do you measure that performance? How do you track that performance? How do you remove variance out of your game? And I'll give you an example as to what is variance. How often do we see traders talk about, well, let price run the highs or the lows, take the highs, reclaim back inside, and put your stop under this low here? Right? That's fine. If people want to do that, there's nothing wrong with that. That's something that I used to do. But how do you measure variance? Because if you repeat that same trade over 100 trades, let's be honest, your stop placement is very much gut feel. It's very much randomness, okay? And I've always said, as I've progressed throughout my own journey, you mature as a trader. You look at more of the nuanced aspects of trading. You can't scale up randomness because that is a high degree of variance that you're going to incorporate in your trading. So really, part and parcel of using some of this tooling, whether, the approach that Magus use or what other traders use, it's about devising the entire trade lifecycle from your framing of the trade, from context through to execution, through to position sizing, through to risk structuring, through to having a repeatable action that you can measure your trades more consistently moving forward. And the one thing that I will say is that, when it comes to all this tooling, well, when do I use market profile? When do I use footprints? When do I look at the tape? When do I look at the DOM or the ladder? When do I use price action charts? And I think four things to remember, really. The price action chart and the market profile gives you context, okay? A footprint tells you what actually happened at a certain level, as do some of the indicators that you can see on your screen with the deltas and the liquidity bubbles. Then you've got the DOM on the ladder of the tape. That's the actual heartbeat of the market. It doesn't get any closer to the action than seeing the orders flowing through the tape or watching the DOM and the ladder, hitting into passive bids or passive asks. And the fourth aspect for me is basically then all your secondary indicators. So I don't really see order flow as some holy grail. It's just something that I personally use that gives me context about what price is doing at this moment in time, and it just gives me a slight advantage as opposed to just relying on a price action chart. But you were talking about the AGA template, and it's interesting to see you've kind of come back to the AGA template. Why do you think that is? From perhaps 2 years ago, what's made you come back to the AGA template?
The simplicity and the speed, is probably what I would say, right? It's a lot more simple. You can It's a simple template, but you can also have it very granular by being on ultra low time frame, and the speed is something that a lot of people would probably not, either they don't know about it or they just don't appreciate it. But pretty much every application you guys use is going to be borrowing the data from somewhere else, where Agar is actually set up to pull the data directly from the exchange. So even though we're only talking about milliseconds, maybe 10 to 100 milliseconds is probably what I would guesstimate the difference is. The information is going to print first on Agar as opposed to something like TradingView or any of the other applications that exist. Legitimately 95+% of the tools that you guys have access to are going to pull the data from somewhere else, at like a third party, right? Where agar and other things like the terminal that I use pull directly from the exchange itself. And so you get the information slightly faster than everybody else, which does matter on some level, especially when you're on the low time frames.
Yeah, yeah, absolutely. And what other tools do you use, or is this pretty much the core for your actual trading when you do trade?
Yeah, so I've covered the TradingView templates pretty much top to bottom. I covered the agar template. So TradingView is where I form context and I get some executional, indications. Agar is a large part of my executional framework. And then the final thing that I would show, which I wonder, oh, I think I closed it out. Hold on. I'll do it like this.
No problems. Take your
I don't know how
time.
to get this pop-up to go away, the screen sharing thing. I think it goes away on its own eventually.
Yeah, we can't see it from our side. But
I
think it's
know,
just
yeah.
inside.
I don't know how to get it to go away though. One second.
Right.
I think it goes away automatically.
Yeah, no
I have one
worries.
more thing which I can start the explanation, which is you need some sort of tool that shows you liquidity, guys. You don't necessarily need it. If I had to choose one or the other between liquidity and takers, I would choose taker flows, which is what this is showing me the people that are sending market orders, right? But having an idea around what's going on with the passive side of things can be really great as well. So unfortunately, it doesn't look like this pop-up wants to go away. I can't click on the...
Yeah, we can't see it on our side. I think it's just your side.
Oh, there we go.
Yeah.
I'll just open it up twice and we'll get it to load that
Yeah.
way. So this is going to show me some of the same taker flow indication, right? Open interest and volume. But the primary thing that I'm using a tool like this for is to identify whether there's more buying or whether there's more resting bids or more resting asks. So this still is going to take a second to load because it has a bunch of indicators, and they're probably not even going to all load up since I have the stream running right now. But basically, it doesn't really matter whether you want to use an order book, a DOM, a heat map, or just a book skew. What you guys see in front of you right now is, I have the order book on the right, I have the heat map in the background, and I have the book skew on the bottom. And you could really use just one of those three things. You don't need all of them. But when I have a read on liquidity, which is what you're seeing here, plus a read from the taker flow, that's how essentially my edge for when to open and close trades comes in. There is some indication around, maybe tape speed is the final part, like when tape is really fast, or there's a lot of trades going through, like the tick rate is really high on markets. That can be an indication to either open or close a position as well. But this is essentially the end all be all for me, right? So to TLDR everything, right? It's VWAP and volume profile, some sort of taker flow information, some sort of liquidity. And then I have a terminal that I execute on where I use tick charts. And that's literally all I need to trade right there.
The order book depth that you've got, I'm assuming one is for spot, one is for perps. Is that correct?
Yeah, the left is for perpetuals and the right is for spot.
Yeah, and I guess on the left-hand side, you've just got these... Is that an aggregated heat map that you're using, or...?
So on the left side is just, this is actually a delta profile. So it's showing me...
Oh, sorry, on the other
buying.
chart, the left-hand chart where you've got the price action. Yeah, this chart. Is that aggregated?
It's the same thing. So on the left side of both of them is the delta profile, and then on the right side of both is the actual live order book.
Yep. Cool. Awesome. And I think the key to all of this really is, like I said earlier, not just using tools for the sake of it, but really developing a system around your trading, which you and I have both done over the years. There are certain reasons why we use certain tools, but we may, look at different aspects of price because that's what forms our own trading strategies. And it's really about understanding yourself as a trader, what type of system you're trying to build. But I think what it comes down to for me is repeatable patterns that you recognize or inefficiencies that the market plays out over and over and over again, and then how you can structure a trade or build a thesis or frame a trade around that, and then start refining that over time. You should be really trading with a purpose, not so much randomness, but really understand what not only price action is doing, but what the microstructure. And when I talk about microstructure, I'm not talking about lower time frame, higher highs or higher lows, but really trying to understand the flows to really understand what's happening under the hood in terms of the candles that you look at on the charts. I mean, again, it's very nuanced because it is geared more towards low time frame trading, but you can use the same concepts and certainly apply this or filter it out to the higher time frame inflection points. So I guess the next question that people are going to be asking is where can they get hold of some of these templates from? Let's just say they want to be the next Magus. Where's the best place to start?
Yeah, so about a little bit over 4.5 years ago, myself and my good friend Charlie, we started the Paragon Group because we wanted to create a place where, essentially what we were looking for when we were learning. So it's been a little bit over 4.5 years now. In October, we'll be at our fifth year. It's been crazy to watch. We've had thousands of traders come through, and a lot of guys have been able to come through and take our style and kind of create their own version of it. So yeah, in the Paragon Group, we have the full body of education and all the tools. Any tools that I use, you could just come and click copy and immediately have the exact version of it that I do.
No, yeah, of course, yeah. I think, look, I've been in the Paragon, as a guest. It's been a pleasure to be invited, and I've been honestly impressed by some of the people that have come in through the Paragon over the years, and just to watch their transformation from kind of very early stage trader to developing some sort of systematic approach. I mean, special shout out to somebody who was in the chat earlier today, which is Nelly, who's turned out to become a phenomenal scalper. I'm sure he's going to have many great years ahead of him. For those of you who enjoy scalping, it's not something that I particularly enjoy doing, but yeah, it's just great to see certain individuals just come through the Paragon and really nail it, from their development of some of the resources that you've shared. So really is a testament, to your own hard work as well, Magus, with what you've taught over the years. But yeah, I think if there's any questions, please do let me know. I think one question came in. What's the tape? The tape is just basically real-time orders flowing through the books. Market buys and market sells. And how can you see it? Well, you actually see it when you log into your exchange. You should see the trades flowing through. Right, that is essentially the tape. On Agger or other platforms, you can filter out the trades by trade size. So you can say, for example, if somebody's trading Bitcoin, you can set a filter that you only want to see trades above 1 Bitcoin. That's just a kind of a filtered approach of seeing the tape. I guess the other concepts that people probably aren't familiar with, and I'll probably let you talk about this more than me, is the difference between time-based and non-time-based execution. Time-based is where you're using anything from the 10-second, 1 minute, 5 minute, 50-minute time period higher to view the market. And then you've got non-time based, which is basically trades that are the number of trades processed through the markets. So 50 trades, 50 ticks, whatever it is. But how do you actually use non-time based versus time based trading? If you just want to quickly elaborate on that for a few minutes, do you still use non-time based execution yourself?
Yeah, that's an easy one for me. Before I do that, though, one more thing to say about the Paragon Group is how we've had people that have come in and have effectively become team members themselves. So not everybody knows this, but Doc was originally a student, and I feel like I have an eye for spotting talent, and I invested some extra time and energy into him early on. And that's the same kind of thing that we're having with Nelly as well, where Nelly now has his own channels and is posting and sharing his own stuff. So it's just the crazy kind of full circle dynamic that plays out where people come in and they kind of prove their worth and end up, effectively becoming team members. And most people don't really think about that as a goal, but it's really cool to watch. But yeah, I can do the non-time based and time based kind of conversation. So most traders immediately are going to be introduced to time based candles. This is going to be any, like XO said, anything from a 10-second candle all the way up to like a yearly candle, right? Where it's just, open and close based off of a specific amount of time. And this is great. Everything that you guys are seeing on my chart right now is time based. The time-based is a lot easier for your applications to load because the data is a lot, more simple. But you have alternative candle types or data types, which are going to be anything like tick charts, which tick charts are something I use a lot of. That's going to be, it makes a new candle every X amount of trades. So if I have 500 tick chart, 500 tick on every 500 trades that go through the market, it will make a new candle. I'll explain why that is useful here in a second after I run through some of the other versions. Some alternative versions would be maybe range based. So, after price moves X amount of dollars. So if it's $100, range, if it moves $100, it will print a new candle. You could have tremor version. So after it moves a certain amount and then moves back a certain amount, it will make a new candle. You could have volume based. So after, maybe instead of it being every 500 trades, it makes a new candle like tick charts. Volume based should be if I have it set to 10 million, after it does $10 million of volume, it will make a new candle. And the reason why these are important to maybe consider throughout your career is because they just present the information in a different way. Where, a simple way that I could explain this would be in moving average terms. If I have a 5 minute candle and it's a 100 moving average or a 25 moving average or something, no matter what's happening in the market, every 5 minutes that goes by, it's going to feed new information to the moving average. And there might not be a whole lot going, you might have 10 5 minute candles that just went by and nothing really happened in the market throughout that, period, right? And you're continuously feeding information to your indicators during that period. But if you have a tick chart or a volume chart or a range chart, it's only going to feed that additional information to your indicators when something actually happens in the market. And I think that, for simple indicators, they're actually 9 times out of 10 going to be a lot better and more useful when they're based off of when new information is actually coming into the market, as opposed to just 5 minutes went by so it prints more data. It won't print new data if nothing happened in the market when you're on these kind of non-time based versions. So that's like the maybe introduction bit, is that it just will print indicators better. I don't really use them for indicators. I use it for feel. So when I use tick charts, that's actually what I execute off of. And it just shows me a very clear indication of these kind of dynamics that we talk about where, is there liquidity in the book, and how aggressive are takers being? Without even looking at any order flow, I can see that kind of relationship very clearly with tick charts, right? Whether price is driving up a lot, driving down a lot, or it's unable to move, right? That's telling me if, the takers are being aggressive, and that's telling me if there's actually a liquidity there in the book or not. I don't need tick charts to trade, but they definitely help me trade a lot better. So that's basically the TLDR of time-based and non-time based. I don't use a lot of I used to use non-time based footprints back when I used footprints back in the day. I used to use like T-Rev or volume-based footprints. Which if you guys are footprint traders, I would really suggest you look at the non-time based versions, because I think that they present the data a lot better most of the time. But I just use simple tick charts to get a feel for when I should be opening and closing my trades in confluence with everything else that I showed you guys today.
Yeah, absolutely. It's interesting. Yeah, I used to use TREF quite a lot, but I've actually gone back to using time-based candles when it comes to footprints. But yeah, question. I think, are your templates? I think you've shared your templates in the past, have you not? Are they available publicly, or?
Older versions of my templates probably are somewhere on my Twitter, but any of the modern stuff is only in Paragon these days. I haven't. Sharing templates is kind of a pain in the ass, to be honest. Maybe like the TradingView one's not that bad because it lets you make the link, but like trading like agar templates or anything else, you have to kind of load it up into some sort of other application and then share it, like Mega Upload or something like that. So I don't really do that very often. I normally just, share the code open source in the Paragon group instead of doing the kind of overly complicated version of it.
Yeah, makes sense. Yeah. Any other topics you want to discuss, or if there's any more questions from the audience, I'll let you ask any questions. But Magus, anything else you wish to cover in today's stream? I think it's been a fairly insightful stream into your workflows and how you set up. I'm sure we could talk all day about the aspects of trading. In fact, I'll ask you a question. Let's just take it back a step. What would your advice be to somebody who's been trading, say, for the best part of a year and a half, maybe 2 years? They're not finding much success. TLDR, what would be the best way for them to really shift their mindset and start thinking about strategy creation when it comes to trading? Because I think for me, when I first started trading in let's say 2016, 2017, 2018, I had no purpose, if that makes sense. I was just randomly marking out SR levels. Sometimes they would work, sometimes they wouldn't. And it isn't really about the technical aspect of trading. I think technicals just play, I would say, 20% part of the qualities required to become a very good trader. Because around technicalities, people think, oh, I need to learn how to read order flow. I need to understand market profile, price action, moving averages, or delta. Yeah, I mean, it helps to absolutely to understand the domain that you're operating in. But it's just, they are small stepping stones as far as I'm concerned. The real shift that you will see, in my opinion, as a trader, is to really look for patterns that repeat throughout time. And the market is essentially three things: mean revert, trend, and stay rotational with ranges, right? Which is a form of mean reversion. So you really want to devise some simple strategies around that. But then you need to think about the trade execution, the risk size, and the framing of the trade. Then you've got to think about your behavioral aspects of the trade. So how do emotions impact your ability to trade? Revenge, fear, greed, oversizing, undersizing, right? You've come off a losing streak, and so now you start undersizing, you start winning some trades, but you should be at least, seeing some positive growth in your account, but you're not, because you're undersizing on your winning trades. You get overconfident, oversize, and you take a big loss. So there's so many facets to trading, and I've always said that one of the best ways to learn and understand about yourself is try to understand your performance as a trader, because without really understanding what you're measuring, you are trading in a very random way. If you can't explain why you're actually executing a trade, as opposed to, oh, look, price traded the swing fail, took out the level and got back under, let me just take a punt. Okay, but why did you take that? Why did you take that trade? Because how many times do we see price, swing fail a level or some high or low? You think it's a perfect setup, you've got the execution on point, but then price carries on going higher or carries on going lower. Why is that? Why do you think price did that? And so, when I first started trading swing fail patterns in 2020, 21, that's what I was in. Just, oh, look, swing fail, let me just short this, let me long this. And then sometimes I'd get run over. And then I couldn't understand, okay, why am I actually getting run over? Because the reality is that I didn't really know, other than, oh, look, swing fail, as to why I'm executing the trade. So it's about having purpose in your game, to really question every single decision that you make, and why are you actually making that decision. But then after you've made your decisions, you want to benchmark your performance and to see kind of like your MAE and your MFEs, okay, and to understand your execution efficiency. So one of the things that I'm working on is, when I've executed a trade, what does price do in the first 5 minutes, 15 minutes, and if it's a higher time frame trade, 1 hour? What I'm asking myself is, how can I become more efficient when it comes to trade execution? Am I too early to the trade? How do I measure that? Am I too late to the trade because I've missed my execution? Why did I miss my execution? Was it because it was a technical reason, or was it because it was a behavioral aspect where I had a level of fear or hesitancy? Because they are emotions that creep into your game. So back to the question, Magus, what would be your advice to somebody who's been in the game for 1 to 2 years? They have some good days, they have some bad days, but they've still got negative equity. They've still got negative expectancy. They're still struggling to make it as a trader. What should a trader do after 1 to 2 years in their journey to really see some real development over the next 12 months?
There's a lot of stuff to break down in that, so I'm going to try to keep it simple and light. A lot of, I'm going to break this down in a second, but like the first thing to say is, you have to really address the psychological components, right? But before I do that, there's a lesson that I always teach to the newer traders, and that it's, if you need to learn to become process oriented over outcome oriented with your trading. If you're trading and you're inexperienced And the reality is a couple of years is still inexperienced. It doesn't matter if you've been putting a lot of time in. This is not the kind of craft that's going to be perfected or, get to that level that you're seeking out in a short period of time, right? Most people aren't savants. You really need to learn to become process oriented, right? So really taking your trades with the goal of trading well and learning how to improve on your decision making and improve on your reads as opposed to how much money can I make in a short period of time, right? So many people sprint towards the goal of growing their capital and hitting X amount of, income from their trading, right? Or, hitting X amount of portfolio amount. And I very strongly believe that if you can take the slow and steady approach, and this is why people teach children the tortoise and the hare lesson, right? The hare never really tends to win the race, that the tortoise that has the slow and stable approach has a much better chance of succeeding. So you need to learn to become process oriented as opposed to outcome oriented. And there's nothing wrong with trading much smaller than you need to or than you have, right? Just because you have X amount of money, you can trade less than that and have a huge emphasis on, getting the repetitions in and building up that skill set and acquiring the knowledge so that you can actually trade, on, real and professional in the later stages. The next thing is just going to be around the psychological components, which is what I touched on at the beginning of this yap. And yes, if you need a framework or some sort of system to trade around to give you confidence to click buttons and like understand that your, expected value is going to be positive at the end of the day, right? But what becomes, in the later stages, the medium to later stages, what becomes a lot more important than knowing I have a positive expectancy is being able to handle the psychological components. I would, just spitball and say that, probably 80, 85, maybe even 90% of this game comes down to how can you handle your successes and how can you handle your failures? Handling your successes sounds like it's easy, and it is easier than your failures, no doubt, but you have to handle your wins appropriately to where you don't get an ego around it. You don't develop the hot hand fallacy where you think, okay, I did well for 3 weeks, so I'm just never going to lose again, and you take excess risk and you lose all your gains, right? So you need to handle your successes well. And where most people struggle, obviously, is how you handle your failures. When you make mistakes, which you will make mistakes, that's like one of the only certainties in trading is that you will make mistakes. So you have to learn how to practice introspection and, self-reflect to lead yourself in the direction of improvement without it becoming this thing that buries you under the pressure to perform and kind of ending up where you just dwell on your mistakes forever. This is something that I struggled with for a long time. I'm very hard on myself when it comes to when I make mistakes. I don't let myself off easy. I think a lot of people in life don't have they don't when you don't trade and when you don't compete in something in life, it's very easy to kind of sweep your faults under the rug and kind of never really face them. But if you want to have success in trading, you have to meet your mistakes and faults head on and address them, and you can't shy away from it. So that's going to be a really difficult thing for most people, and this is probably one of the primary things that makes people quit trading is that you have to face your mistakes and like figure out how, okay, I did this mistake and or I've repeated this mistake a lot the past month. How do I fix it? And that's like not an easy thing, for any of us. It doesn't matter if you traded for a long time or if you traded for a short period of time. Like addressing your faults as a person is a very hard for all of us. And if you can figure out how to push your way through that, it's not only going to make you have a better chance of succeeding with your trading, but people don't really expect it when I say this, but it's going to make you a better person, right? The person that is not afraid to face their faults is going to be a much more balanced individual in life when things happen to you where there's an issue with your family or an issue with your friends, for example. When you have already faced your faults head on, you're not going to you're going to be able to like kind of overcome the issues that come later in life, if you will.
Yeah, no, absolutely spot on. Great points, Magus. Absolutely hit the nail on the head. And I think I would just like to add one thing to that is it's very easy to be distorted by social media as to what good trading is. You know, it's very easy to get suckered into the thought that you see accounts sharing large P&L wins. Okay, number one, you don't know where they get, how or where they have access to their capital from. Number two is when you see certain accounts talking about the fact that they've grown an account in 3 weeks, double their account. Well, in all honesty, a lot of that can really lead to imposter syndrome, where you feel as though you're underperforming everybody else. Let me break it down to you this way. You know, when I first started in crypto, that's kind of what I used to do. I used to trade in that way, where I'd see others making really good money and sharing their wins, and that would then cause me to oversize and become more of a degenerate. And I think it's very, very unhealthy for your development as a trader. You should be thinking 5 years, 6 years, 7 years. You know, do you want to trade as a living? Do you want to trade as your career? Do you want to become a trader, you know, as your career choice? And just start with some very simple metrics that, when you look at it from a professional perspective or a prop firm perspective or a hedge fund perspective, if you can just try to aim for 1% account growth per week, it doesn't sound like a lot, okay? And if you've got sensible risk management, then you shouldn't be oversizing on your trades. And when you really think about the compounding aspects, where let's just say on average you're aiming for 1% a month, that's 4%, okay? Over a year, that's around about 40, 50%. Now, you may look at that and think, well, I've only got a small account, XO. You know, I've only got $1,000 account or a $10,000 account. That's defeating the purpose, okay? Because it's not about what your account size is. Yes, we all want to make money, but at the end of the day, you've got to earn the right to add more capital and to trade more capital, because if you don't, then whether you put $10,000 or $100,000 into an account without any positive expectancy, without any proven edges, okay? Edge isn't just one thing. It's a culmination of various facets of trading. Only then should you have the confidence to start sizing up. So really, for me, when I think about trading, it's not so much about what's your P&L gain. It's about your performance gain. What expectancy do you have? How do you measure that? And if you can achieve, honestly, if you can even just achieve, you know, 20, 30% account growth in the first 2-3 years of your trading career, that's something that you can work with and refine over time. And you will see your expectancy improve. You'll see your trade selection improve. You'll see your filtering of your trading, of your trade selection improve, and you'll start reading the market better, especially when it comes to reading the market in real time. I think that's one of the key skill sets that you have to develop as a trader. So, you know, that's my 1 cent. Kind of ignore everything that you see glamorized on the timeline when it comes to P&L flashing, or, you know, here's a trading competition that I did and I took 10,000 to 150K in 3 weeks. Like, okay, try doing that over the next 20 times. Chances are, I would say 80-20, Pareto's law, Pareto's principle, they're probably going to blow out 80% of the time. The one time that they did do it, hey, well, guess what? That was probably just a one-off of maybe 2 out of 10 that they would probably be able to replicate that success. And around that really comes down to, well, the person who probably can do that understands which market environment they can actually floor it as well. So there's so much under the surface that people don't really talk about, and there's so much bad advice, and it's easy to get caught up with the fact that you think you're underperforming, where really slow and steady should win the race over the long period of time. Okay. I think we better wrap up the stream. We've been on stream for an hour and a half. There's a few more questions coming in, but we probably, if you would just leave them in the comments, I'm sure myself or Magus can take time to just answer 1 or 2 questions. But I think that's it, Magus. Have you any final thoughts or anything that you want to add to today's conversation?
Just some closing remarks would be, hopefully the guys that have been listening today have learned something. Hopefully, you know, you either learned from the kind of more technical, you know, frameworks side of things, or hopefully you, even more important, hopefully you learned something about the psychological components, because that is, at the end of the day, what's going to really separate one discretionary trader from another, is being able to handle the pressure when you're failing, and being able to handle the sunlight when you're doing well. If you guys want to expedite your learning curve and learn to trade with us, then then I would consider joining the Paragon group. I wouldn't shill that if I wasn't confident, having watched so many traders join and hit their stride and find success on their own. So yeah, that's pretty much it for me.
Yeah, I think it's important to emphasize it's not just about the Paragon. It's not about you're gonna enter a group like the Paragon and expect to receive calls. It's really about trader development. And I think when I left my review about the Paragon, to me, it's probably one of those environments where if you want to enhance your trading, when it comes to trading futures or perps, then it's probably one of the best environments that you can be in. And I always encourage, traders or prospective traders, you can do it the way that I've done it, which is the long journey yourself. You're discovering the markets, you're learning as you go along, or you can, certainly tap into various educational groups where it kind of gives you a foundation of the direction that you should be going towards. And I think it's a testament, that I've been in various groups, and for me, the one group that I said to you, Magus, as well, the one group that I find myself interacting with some of the traders is the Paragon. And I think at the end of the day, it really comes down to having a foundation. It's a very difficult path by yourself. You've got to surround yourself with seasoned traders who've kind of gone through that long learning process and really tap into their knowledge as to how they can give you not mentoring, but kind of a structured way in how you can improve. And obviously, I've been running almost what I would describe as a free mentorship, which ends in June, and I'll be taking a break from that. But it's great to see the likes of Magus and Charlie, who are founders of the Paragon, and then Doc, who later emerged as a really good trader, and Nelly, who's become a phenomenal scalper. So it's just great to see traders doing really well, and to kind of share not what trades they're taking, but their process, their strategy, their reasoning, their thinking behind the trades. And I think there's no substitution for that. The last thing you want is somebody to give you calls. And the minute you start following other people's trades ideas, that's very much a very, very C game trait. Okay, you want to become an A-star trader, then you've got to really understand what it entails to become a successful trader. Okay, and everybody's got a different approach to trading. So that's my honest thoughts, my honest opinions. That if you're serious about shifting your mindset towards becoming a better trader, then you've kind of got to go to where, as with anything in life, when you want to become a surgeon, you want to become a doctor or a lawyer, you've got to seek that education from somewhere, right? So, that's not me just talking about the Paragon. I'm sure there's many of the services that are pretty good out there as well. So one of the things I've always encouraged aspiring traders is that go and spend some time in various groups and services. Just acquire as much knowledge as you can in your first 1 or 2 years, create a foundation, and then you're pretty much good to go by yourself. You'll start developing a system and a strategy for yourself. All right. So I think thanks, Magus, for today's stream. It would be good to probably touch base at some point later this year. I'm sure we will do. But final thoughts, closing thoughts. I know you've already said that once, but don't know if there's anything else you wish to add. Other than that, we can wrap it up.
Yeah, we can wrap it up there. Thanks for having me on, and hopefully the viewers learned something today. It's always my goal with the public speaking is to try to pass on some sort of knowledge.
Yeah, thank you very much. All right, thank you guys and girls for tuning in. I hope you have a great week ahead. Just be cautious on Bitcoin. We have seen a bit of a breakdown, but we'll certainly pick things up on the mentorship that I'm running over the weekend. So wish you all a fab week ahead. I should have another stream later this month for Bitcoin, where I'll break down the charts and the trades that I'm looking to take. But until then, catch you next time. Take care. Thank you.